So I want to talk about asset pricing in the dark. And this is a paper that looks at a fairly unusual asset price universe. And I say unusual because we concentrate most of our time on efficient liquid markets. And if we really have skill, if we look at active management and all our talents and skill employed to generate value, what are sort of the markets that we kind of would like to be in? Would we want to trade in a market where everyone sees prices, everyone sees the same information? If we're very skillful, we can get better information, and everyone pays fairly low transactions costs, and if you're very clever, you can actually pay extremely low transactions costs. So would we rather that market, or a market where information is hard to procure, not everyone sees the same information, you don't even see prices? Information doesn't really get incorporated into prices that efficiently or quickly. And transactions costs are large, and if you're very clever, you can pay low transactions costs when most people are paying punishing transactions costs. Now, what kind of market would we want? Obviously, if we're very skillful, we want the market that's inefficient, because that's exactly where we can make a killing. And those are the markets that I'm going to be talking about today. Now, that's not to say there's value, that we can't generate value in efficient markets. As our former speaker, Lasse Peterson, shows, yes, there are substantial premiums in those markets too. But there are also large areas of profitability in inefficient markets. And those are the markets I'm going to be talking about today. Asset pricing in the dark. So I'm going to be talking about over-the-counter stock markets. And over-the-counter stock markets, we're going to define this as OTCBB, the OTC Bulletin Board, or pink OTC markets, which were formerly called pink sheets or PS. These are large markets. There are approximately 67,000 stocks that are traded on these markets. We have a long time series, 1977 through 2008. And we believe this paper brings to the profession, both the academic and practitioners, the largest data set on US stocks since the introduction of NASDAQ in its data sets in 1984. Now, this market is interesting because it's the wild, wild west of securities markets. This is what the SEC says about these markets, and it's worth reading this quote in its entirety. So from the SEC, PinkQuote does not require companies whose securities are quoted on its system to meet any eligibility requirements. With the exception of some foreign issues, the companies quoted on PinkQuote tend to be closely held, very small, and/or thinly traded. Most issuers do not meet the minimum listing requirements for trading on a national exchange. Many of the companies do not file periodic reports or audited financial statements with the SEC. As such, it may be difficult for the public to find current reliable information about companies quoted through PinkQuote. And I've highlighted some of these words because this is exactly the sort of market structure that we're going to exploit to test some theories of asset pricing. First of all, in liquid markets, especially in liquid stock markets, you can get information on a company's financials with one mouse click. You can do that in a standardized format, going back years, and easily compare different companies. It's impossible to do that in pink sheet markets. So information in these markets is actually non-existent, or it's very poor. There are lots of very large, clever institutions in liquid markets. In these OTC stock markets, we don't see very smart sovereign wealth funds, or hedge funds, or pension funds. So most of the clienteles are also different. And these markets are very illiquid. As the SEC says, these stocks tend to be closely held, very small, and/or very thinly traded. Now, if we want to look at illiquidity premiums, sure, we can look at illiquidity premiums on liquid stock markets, but let's look at illiquidity premiums in actually illiquid markets. And here's one of them, and that's what we'll do today. So there are some similarities. Companies that go bankrupt, for example, or fallen angels, transition from those liquid markets to these OTC stock markets. And I'll give you some examples later on. There are some transitions the other ways as well. If a company happens to be very successful, it starts off very small, and then in its life cycle transitions to a listed exchange. So there's transitions back and forth. We're going to concentrate only on those stocks in that OTC universe. One advantage of these OTC stocks is that they are US stocks. If we go to emerging markets or overseas markets, then we have problems about how similar the rights of creditors and the rights of shareholders are across international jurisdictions. There's nothing like that here. These are US companies. The other similarity between these is that there are some market makers that trade both OTC stocks and listed stocks too. But for the large part, the clienteles are quite different. So what are the differences between these OTC and listed markets? Well, first of all, as the SEC says, sometimes OTC stocks have no disclosure at all. So if we want to test theories involving some kind of information, then it's hard to do in liquid markets because information is either good or excellent. Here we actually have a market where information can be good and it can be totally non-existent. So we can look at those disclosures. The second is that these are very illiquid markets. And I'm going to show you that there are stocks that take days before you can see a trade. So we can look at illiquidity premiums in illiquid settings. Another difference are these clienteles. We don't have these traditional institutions in these markets. Further, it's going to be very hard to short in these OTC markets. So all of these differences are ideal venues to go and test theories about the determinants of some of the most common asset pricing cross-sectional premiums that we've seen in some of the liquid markets. So we're going to exploit these features to distinguish among theories of return premiums. We can look at rational versus behavioral theories, and we're going to look at specific behavioral theories which involve information being very hard to analyze or procure, and the inability for investors to short those assets. And this is a long literature that goes back to Miller in 1977, and many of those features where there's large differences in opinion, we have heterogeneity of clients, and it's very hard to short, will give rise to some of the asset pricing features that we see in OTC markets. Our strategy in this paper is to estimate and contrast return premiums within and across OTC markets and listed markets. I'm going to sort by different characteristics, like book to market, like past returns, like momentum, like volatility in these OTC and listed markets. Now let me give you a preview of the results, and then the rest of the talk will examine some of the stories behind these results and delve deeper into them. What we're doing here is reporting annualized Sharpe ratios of different cross-sectional return premiums. P&T stands for the probability of no trade. It's just the frequency of non-trading occurrences within the past month. Volume is simply trading volume within the past month. We have size, which is market cap. Value, which is the traditional one being the ratio of book to stock prices. Volatility is actually idiosyncratic volatility defined relative to a systematic Farmer and French model. And then momentum is just past returns. We have two columns. On the left side in that red are the premiums in the OTC markets. And in the right column, on the right, the blue one, we have the premiums in a comparable listed universe. Comparable meaning that we have stocks of similar size, but they're traded on the NASDAQ, Amex, and NYIC. So the first two of these show us liquidity. So we have liquidity, illiquidity, defined as not being able to trade very often. So P&T, when P&T is high, well, we see that the OTC stock illiquidity premium, that Sharpe ratio is very close to 1 compared to about, far less than about 0.2 for the listed markets. Volume is another measure of illiquidity. So we have more volume, we are more liquid. Here we see that greater volume corresponds to much lower returns in the OTC universe. So the first two columns show us that illiquidity premiums are an order of magnitude. We have to put zeros on the expected returns. The Sharpe ratios we multiply by fairly large numbers. Those illiquidity premiums are massive in these illiquid OTC stocks compared to liquid public markets. The second result is these common cross-sectional anomalies, size and value, and the low vol effect, sometimes called the risk anomaly. You can see that those premiums are somewhat comparable. So size and value are going to exist, volatility effect exists. So they are similar in those respects. I'm going to show you, though, that the OTC size, value, and volatility premiums, although the magnitudes are roughly the same, they're hard to explain by the same listed factors that we see in NYSE, Amex, and NASDAQ stocks. And one very surprising fact is that momentum is very weak in OTC markets. And why I found this surprising is I used to believe that momentum was pervasive. We see it in commodities, we see it in fixed income, we see it in foreign exchange, we see it in equities, we see it across geographical regions around the world, everywhere except here. Now, that's not to say momentum doesn't exist. It is there, but you can see those magnitudes are very different in the momentum premium across OTC and listed markets. And I'm going to exploit that because this is a theory that there are different theories about momentum, and we can dig down and exploit these institutional features of the different clienteles, illiquidity, the lack of disclosure of information, in trying to explain and differentiate some theories of momentum. So illiquidity is very large in these illiquid markets. We have similar size, value, and volatility premiums, and momentum is extremely weak in these OTC markets. So here's some brief background on these OTC markets. They really actually aren't over-the-counter as in fixed income is over-the-counter. There is a centralized market for this, but we refer to OTC because it's very different from the listed NYSE, NASDAQ, and Amex markets. The OTC market that we define as OTC CBB and pink sheets. Legally, we need at least one FINRA member who is willing to be a market maker, and there are approximately 200 market makers who must trade at their public quotes. These prices must be reported. There are different data collection institutions that will collate this information and then pass it on to market participants. We take one from Market QA. This market is regulated by FINRA, once NASD, and the SEC. There are minimal financial disclosure requirements. So for most of our sample, actually, there were no disclosure requirements at all. Since 2000, the OTCBB, but not the pink sheet markets, requires annual reports and an annual shareholder meeting. So all those disclosures are driven under Section 12G of the Exchange Act. There are actually still ways to get around that. That requires, say, 500 shareholders of record for an OTC firm to have some disclosure. But even then, you can get around that because you can put things in street name rather than the actual underlying shareholder name. There are very different heterogeneous sizes in this market, liquidity and transparency being the same. And one major difference between this market and the listed market is that individual investors dominate in the OTC market versus the listed stock markets. Our sample is going to deliberately exclude firms that trade jointly on the listed markets and the OTCC. Now, we're going to take the OTC market, this asset pricing in the dark market, and that's our exclusive focus. It's going to be interesting to actually look at transitions between these liquid and illiquid markets, but that's not the focus of today's paper. We're going to be exclusively looking at the OTC universe. There are lots of data filters that we put on. We need this because information is of relatively poor quality compared to the liquid markets. So the major filter here is actually the market cap. That is about 30% that will throw out of those firms. After all of those filters, we have about 500 firms per month. Now, we want to construct firms that are similar to this OTC universe. So we're going to construct two comparable samples. Now, one of them we're actually going to call comparable, and that comparable sample are firms that are similar in size. So we take eligible listed firms with the median OTC size. Now, the other one is basically the complete list of all firms on the NYSE, Amex, and NASDAQ. It's a little bit different from the complete universe because we have the same data filters that are applied to the listed universes as in our OTC universes. Now, let me show you how these firms stack up against these listed firms. Now, we know that they're going to be much smaller. So the eligible comparable OTC and comparable listed samples, we have median firm sizes of about $13 million. The eligible listed sample is about 36. This figure looks at comparison in more detail. First of all, we have the number of firms in the green, the number of firms that are traded on the OTC markets. That's this line here. So on average, we have approximately 10% of just the numbers of firms, of the 5,000 or so firms listed on the standard exchanges, we have about 10% of those on the OTC universe. Now that has tremendously increased in this, you can see. And it's actually undergone several different regimes in here. During the late 1990s down here, this is the internet boom. So there are a lot of technology firms that didn't meet the listing requirements to go onto NASDAQ, but you still want to invest in those, and so they went to the OTC markets. And then we have a big effect here in 2003. You can see this enormous increase in the number of firms after 2003, and that's driven by Sarbanes-Oxley. That piece of legislation encouraged more firms to actually go dark, because why meet all those extra costs associated with disclosure? We see here also the average size of those firms. So the average size compared to the whole listed universe is about 10% on average. And then finally, the blue line lists average volume. So average volume is much smaller, well below 5% for these firms. It's approximately around 2 to 3%. These are very, very illiquid markets. There is actually a regime change here, and that's not caused by the OTC markets actually becoming more liquid. That's actually a data reporting problem. We don't see volume on all the stocks, and coverage increases at this point in time in 1995. Had we actually got all that data that we had post-95, we would actually see that volume actually go down too. So that's really a problem of the data base that we have. Okay, so that's our comparisons between the OTC and the listed markets. What are some of these companies? Well, here are the top 5 in our data. So this is nice because this illustrates out the major types of companies here that Harry Markowitz said about how can you characterize this universe. So public supermarkets, if you're ever down in Florida, you probably stop off right down there and buy groceries at this firm. This is a private market. It's never traded on a public exchange. And sometimes it's very large. So at its peak size, this was a $90 billion company. This is a very large company. There are some extremely large companies that trade on the OTC. Now, there are extremely small companies as well. I should have mentioned that the OTC market, we've only taken US firms. We've actually excluded all the other firms. And one characterization of this market is because there is no disclosure, there's a lot of foreign companies, particularly Chinese and Indian companies, that are listing on these OTC markets. The second firm here, Delphi, is a great example of a company that went bankrupt. It went from the listed markets and doesn't disappear, goes through bankruptcy, and when it's in bankruptcy, it trades on the pink sheets. The last company here, Level 3, is a company that started off in the OTC markets and actually transitioned to the main markets. So it started off here. It's a classic sort of startup. It's a telecommunications company, and it eventually, still listed today, it eventually went and transitioned to the major markets. Now this slide shows us some of those differences that I alluded to before, but now in a bit more quantitative detail. The first line here is very interesting. This is the market return of the OTC markets, and it's actually negative. Okay, it's very close to 0, but it's slightly negative. You can contrast that to the monthly return that we see in the NYSE, Amex, and NASDAQ. In fact, if you hold the market portfolio, Not that there is a traded OTC market portfolio, but if you were to hold it, you would actually lose money. So that's a fact that's surprising. It's actually not our result. It's been found by Iraq and Reedy and some other papers too, but it is extremely interesting. Now the second row here is disclosure. Disclosure we're defining as a dummy variable. It's just 0, 1 to whether that firm reports book equity. So we can construct a book to market ratio. We get book equity from Compustat, Reuters Fundamentals, or from Audit Analytics. You can see the third row, size, by construction, we've created both the comparable listed universe and our OTC universe to have the same size. So that's driven by the universes that we've created. Let me go to volatility. So volatility, that OTC number is 6.56 compared to 4.29 for our listed universe. So these companies on the OTC are smaller than the listed one, and they're also more volatile. Now, if you actually believe the low risk anomaly effect, it actually could be that that market negative return for OTC stocks might be driven by the low vol effect. So we have high volatility firms with very low returns. Well, the OTC universe, these are high volatility firms. Naturally, they might have very low returns. And I'll have some more to say about that later on. P&T, this is the illiquidity variable. So the higher that probability of no trade, the more illiquid, and you can see that firms on the OTC are much more illiquid than the comparable sample. Now, institutional holdings, that's the last one. This is a 0 or 1 variable for whether an institution holds it. Institutions defined here as whether you're reporting to a 13F or you're a mutual fund, so that we can pick it up from an NCSR and NQ report. Now, this number here is actually, it's a little too large. And it's a little too large precisely because of all those institutions that used to hold firms like Delphi, and they continue to hold it when it transitions to the pink sheets. If you were to take that out, this number falls substantially from 0.26 to below 0.1. Most institutions aren't holding firms that start off like level 3 communications when it's actually a startup, when it starts off in these OTC markets. They only hold these firms once they transition to the listed markets. So most of this institutional holding actually comes from fallen angels. Now, there are lots of data issues with these OTC markets. Let me just talk about one of them, because actually we have Rob Stambaugh who's speaking to us this afternoon. One major problem is Bidask Bounce, and that was identified by Bloom and Stambaugh in 1983. Bidask Bounce makes your returns look too good in the data. Now, we need to adjust for that. I'm going to adjust for that via a method found by Asperahova, Bessenbinder, and Kalcheva. What does this do? Well, what bid-ask bounce is that if we think about the bid and ask, we have a bid-ask spread, and if we're sitting here at the lower point, then our returns kind of look too good because we either stay or we're going to transition up to the uppermost point of that bid-ask spread. Now, we're sitting on that bid-ask spread as well, but we're sitting at the top. Then those returns actually are going to look too low because we can either sit or we transition down. So we need to take that out. So basically what this means is that the returns, if we're sitting at the top of the bid-ask spread, these are too low. Returns at the bottom, these are kind of too high. There's this bid-ask bounce that goes into making this expected return too good. Now, we need to go in exactly that opposite way. So we're going to overweight these ones up here. Those actually have low returns. That's going to take out this bid-ask bias. And we're going to underweight these firms here, which contributes to this higher expected return. And that's this method. It actually weights by the gross return. And if you do that, you obtain a return that takes out that bid-ask bias. We also need to adjust for non-synchronous trading. There's lots of these stocks that don't trade every day. So we have a model for non-synchronous trading. And we extend that model to multiple factors because we want to control for factors like size and value and momentum. We have lots of data checks as well. So we have spurious extreme return reversals can occur. We look at this data both from programs and from our eyeball metric tests. So we're going to look at now these return premiums after we've looked at all this data checks. We're going to sort OTC firms into buckets, into quintiles. And we're going to do this each month based on a characteristic like size or past returns. And once we've done that, we're going to look at the premiums that we see in these OTC markets compared to the premiums in the listed ones. We're going to be careful of all this non-synchronous trading in the alphas and the betas that we're going to compute. And I'm going to show you in this presentation Sharpe and information ratios. Remember, the OTC stocks are more volatile, so they're going to have a higher alphas. We want to adjust for the volatility associated with the higher alphas, and so we're going to compute out information and Sharpe ratios. This presentation is going to report that in an annualized fashion. The first two of these, the first two rows, is illiquidity. I want to show you those illiquidity premiums in the OTC markets. These are about 5 times as large as the illiquidity premiums in the listed ones. Illiquid markets here carry substantial illiquidity premiums. So that's our first result. We can see that repeated for volume. Size and value carry approximately the same premiums as the listed markets do. So does volatility at first glance. Momentum, as I showed you before with those Sharpe ratios, momentum is weaker in these OTC markets, surprisingly, than in the listed ones. So you can see the momentum here being 0.54, far less than the 1.71 in the comparable listed sample in the listed OTC, so in the listed NASDAQ, NYSE, and Amex markets. And finally, the last line is just a repeat of what we've seen before, that actually the OTC market actually has a negative return. Now, what's interesting about this is how much we can explain of these return premiums by looking at listed factors. And that's what the next slide does. So even though this market is very illiquid, and we would expect high illiquidity premiums in this illiquid market, very little of this illiquidity premium can be attributed to liquidity found in the liquid markets. And we can see that in this column with the betas of these illiquidity factor. This is actually Rob Stambaugh's illiquidity factor. It's a Pastor Stambaugh factor that captures illiquidity, but in liquid markets. Those factor loadings are very small. So there is a large illiquidity premium here, but it can't be explained by co-movement with illiquidity in the liquid markets. We also saw that size and value are similar to these listed markets too. But we can't explain those size and value premiums with the liquid size and value factors. Those factor loadings that we see here actually are insignificant and even go the wrong way in some cases. So even though the premiums for size and value seem to be similar, we have a hard time explaining them with size and value in the liquid markets. The one that we can explain is actually momentum. Momentum, in fact, actually disappears totally once we control for momentum in the liquid markets. You can see this very strong loading on momentum, this 1.09 loading, and in fact the alpha just disappears once we control for that. Another one that actually becomes much weaker is volatility. That low vol, low risk anomaly seems to also become weaker once we control for low vol or that risk anomaly in the liquid markets. So just to summarize, what we have is illiquidity is really big, size and value seem to be similar, momentum is very weak, momentum and volatility seem to become weaker and disappear almost entirely in the case of momentum once we control for liquid effects of those cross-sectional anomalies. Now let's focus first on the biggest one, which was illiquidity. So in this plot, I've graphed the value of $1 invested in a non-trading factor. So this is this probability of no trade. You want to look at stocks that you hold lots of stocks that are more illiquid and short stocks that are very liquid. The red line here, which is the line that dominates over the full sample, is the amount of money that we would have earned starting of $1 invested at January 1977 in the OTC illiquidity factor. And that blows everything out of the water. That's much higher. Remember, the Sharpe ratios are 3 to 4 times higher here. That's much higher than looking at harvesting illiquidity in the liquid markets. So we have Pastor Stambaugh on the orange line, And then we have those P and T factors in the listed markets in the green and blue. In fact, in the blue line, which is the eligible listed sample, you actually lose money trading this illiquidity factor. So that's the P and T illiquidity factor in the listed markets. So illiquidity here is a very, very big effect. Now the OTC universe, because it has different clienteles, because it is very liquid, because it has different information, we can go further and test some theories of illiquidity. I'm going to do that now. So one theory about why you would see an illiquidity premium is due to Armahid and Mendelssohn and Constantinides, which are these transactions cost theories of liquidity. The premiums for illiquidity should be higher to compensate for the higher transactions costs for trading those more illiquid stocks. We can go further. Those theories also predict that the pre-cost alphas should equal the typical invested trading cost. That trading cost is simply bid-ask spread times the turnover in those markets. We find that those theories are rejected in the OTC market. Those transactions cost theories predict that the OTC stock should have higher returns than listed stocks, and the risk-adjusted return should always be positive. Those transactions costs are small relative to the pre-cost premiums that we see. Furthermore, the returns sorted by bid-ask spreads should be increasing and weakly concave, but I'm going to show you that they're actually not. Why concave? Well, it's actually in these theories that the representative agent actually has curvature in his or her utility function. And so because of that curvature, the long horizon investor doesn't need to be compensated as much as the short horizon investor, and that induces this nonlinearity in that illiquidity premium. So let's have a look at some of these theories. On the left-hand side here, what we've plotted are the differences in returns for the alphas for liquid to illiquid stocks. So here we have down here on the left-hand side, we have liquid stocks. They actually have negative returns. These transactions cost theories can never be negative for any group of stocks. All the way to positive, that difference is about 5%. If we look at the transactions cost themselves, well, they actually go the wrong way. Transactions costs here are actually decreasing. They're decreasing because even though the spreads are increasing for liquid stocks, the turnover reduces more. So these transactions cost theories are actually rejected. We can see the comparable picture for the listed sample. So these are firms that have the same sort of market cap. And actually that theory is actually fairly weak in that sample too. What about this concavity or convexity for these things? Well, for the comparable listed sample, you can actually construct a formal test. If you just use your eyes, you can see that this is actually a little bit weakly concave, but the comparable listed sample goes the totally opposite way. If anything, we can actually see that this is slightly convex. And if we run a formal test, we will reject this implication of these transactions cost theories too. So this OTC sample actually gives us a window into the determinants of that illiquidity premium, or at least it's probably not due to transactions costs. We also run these cross-sectional regressions. We're going to put returns on the left-hand side. We put a whole bunch of variables on the right-hand side. This follows a very long literature in finance. They have very similar results to the portfolio returns that I've shown you. And I won't cover them now, but they are covered in detail in the paper. Now let's go to exploiting these institutional features of the OTC market. Remember, this market, we said, was illiquid. We've seen those illiquidity premiums. This market has very little, sometimes no disclosure, unlike the listed markets. And in this market, there are few institutions and it's very hard to short. So can we construct some theories or build on the literature to explain some of the premiums that we see? We can. So we see lower negative returns to the OTC market on average. We see low returns for liquid stocks, volatile stocks, and growth stocks. Those are going to be exacerbated with high differences in opinion. And we have low returns for large stocks, potentially those stocks with high attention and a large investor base. Yeah, so the question is, can some of these premiums be explained by corporate events, particularly bankruptcy? My short answer to that is no, because we're actually taking only stocks that, so if you were to look at stocks only that did not transition from the listed markets to the OTC ones, you actually see exactly these same premiums as well. But a better test, and that's why we actually only focus on the OTC universe itself, a better test would actually be to take even a more select group of stocks, which are those stocks that actually haven't touched the, haven't transitioned from the listed to the OTC market, and actually see the effects in those stocks that transition to those listed stocks. Those are potentially stocks that actually are extremely attractive, with very good growth prospects, and are doing really well. Again, we see these cross-sectional premiums there too. All right. So what's the theory that would explain this? Well, it's actually due to Miller 1977. Leslie Peterson himself has done work on similar theories as well. We have here stocks that are very hard to short. We have an investor clientele universe, which is extremely diffuse. They're holding very large differences of opinion. Things become very overpriced. And that explains the very low returns to the market as a whole. Now, disclosure, or lack thereof, is going to exacerbate this. Because if you don't have disclosure, then people are forming their expectations in a vacuum. Once you disclose, there is information around which your opinions can coalesce. So disclosure helps to resolve investor disagreement, and disclosing firms should therefore be less overpriced. These premiums should be reduced, and we should see fewer of these mispricing effects or return premiums in stocks with good disclosure. So lack of disclosure exacerbates the impact of the differences in opinion. So we can go test that. So we can, in this universe, actually look at disclosure. Hard to do this sort of exercise in the listed markets because everyone discloses. But there are firms here that actually disclose, and some firms that are totally dark. Some firms actually switch between those two. But the important thing is that if you want to look at the effect or lack of disclosure, this is the universe to do that. Another thing that you can look at is differences in opinion. Because most of these stocks are not held by institutions, retail investors, with long literatures pioneered by Barber and Odin, retail investors tend to be very overconfident. Not to say that institutions are not overconfident, it's that retail investors are probably much more overconfident than institutions are. So we can look at these variables in the special OTC universe. To test these conjectures, we can compare return premiums in portfolios sorted by disclosure and institutional holdings. So let's look at these premiums sorted by institutional holdings. So the theory suggests that the premiums should be larger in those stocks that are not held by institutions. These are stocks where there are large differences in opinion, where the mispricing can be very large, and the return premiums are consequently very large. And we see that. So here we looked at these two graphs. We have on the left-hand side, those are stocks held by institutions where the differences of opinion are presumably low. And on the right-hand side, those are the return premiums in stocks that are not held by institutions, predominantly by retail investors, where those differences of opinion are very large. As the theory suggests, all those return premiums are higher for those stocks not held by institutions, with one exception. You can see that exception on the very right-hand side, which is momentum. And I will come back to that because momentum itself has been very interesting. We see actually momentum being weak here, and it doesn't really matter if institutions hold these momentum stocks or not. What about disclosure? The theory also suggests that if you disclose, then there should be fewer differences of opinion, and so therefore these return premiums should be smaller. And that's also what we see. Firms with high disclosure, where there's lots of information, those are firms where differences of opinion are narrowed because we actually see that information. We see those return premiums also being smaller in those markets, with one exception too, which is the very right-hand side of that graph, which is momentum. Momentum, it turns out, actually has a larger return effect for those stocks which actually disclose more. So can we actually look at that momentum in a bit more detail? Because these are results that seem contrary to everything else. And again, the OTC universe gives us a venue to test some of these momentum theories. There are two main theories of momentum, and they're actually at odds against each other. Both of them are behavioral, but one theory of momentum says that actually stocks seem to go up, that those stocks who have had past high returns continue their high returns in the future. Well, potentially that's because people have underreacted to that information, and so information hasn't gotten out, and so the stocks continue to drift upward. But it could be that information does come out, but people actually overreact to that, and that sends that stock price too high to what it actually should be. Now, OTC stocks here actually trade in a very low information environment. Few investors can observe those firms' fundamentals, especially for stocks that don't disclose. News, if you actually see news, travels pretty slowly, if it travels at all. And information disclosed by OTC firms is itself less credible than information for firms that disclose in the listed markets. So our results for momentum are probably most consistent with Hong and Stein. In the Hong and Stein model, momentum is caused by a group of investors who actually receive news first. Well, if there's no news, if there's no disclosure, how can momentum even start to actually take effect? So we see here a universe where there is little disclosure, and we see very little effect of momentum. So if the Hong and Stein theory is correct, where we see a group of investors, these news watchers, they start to receive that information, and then information filters out to the broader population, we're going to see those stock prices slowly move up as information slowly diffuses out. If you don't see that information in the first place, you won't get that momentum. So this theory has two implications. One is that if we see listed momentum in listed stock universes, that's where information is great. You've got lots of news watchers there. That momentum should be stronger. That's what we see. The second one is that momentum should be high amongst those OTC stocks that actually news watchers might follow, those stocks with disclosure. And that's what we saw on this slide. Momentum has a stronger effect. We see it have a higher return premium for those stocks that actually have news, for those stocks that have information. So can we actually look at momentum in this Hong and Stein framework? So first of all, we see evidence consistent with that. Once we actually see news, that's something that news watchers can grab, and then we actually see higher momentum effects in those stocks that disclose. Now there's another thing that comes out from these underreaction versus overreaction stories, and that is we can test for long-term reversal or continuation. Now, momentum is weak, but that's not to say that there is no momentum in this OTC stock universe. There is. So we can actually take those stocks with momentum, and we're going to construct long horizon portfolios. So this is looking at momentum effects over 1 to 5 year periods. So is there a reversal that comes back, or is there continuation? We see actually no evidence of reversal after 5 years for momentum stocks in the OTC markets. There is weak evidence for reversal, consistent with a large number of studies for momentum in listed universes. That's the green line that you can see with this slight U shape at the bottom of this picture. But for our OTC universe, we actually don't see that at all. Now, there are some alternative momentum theories that we can rule out. So some of these alternative momentum theories is that, well, this is a universe that we have in the OTC markets which are dominated by retail investors. Perhaps momentum is just caused by silly retail people that chase past returns. They're all retail people in this market, and momentum's really weak. So that by itself probably can rule out some of these non-sophisticated theories of momentum. We can also rule out overconfidence and self-attribution bias, which would cause this long-term reversal in these returns. Now, what about institutions? There are some recent theories that actually say that momentum is caused by agency problems, flows coming into these funds, those funds, therefore, with these persistent flows, contributing to momentum effects. Now, we didn't actually see much effects when we cut momentum by institutions held and non-institutions. But we actually don't see momentum in the OTC market where there are very few institutions to begin with. So I think the jury is still out here. By institutions, if we mean institutions like pension funds, then pension funds certainly aren't players in these OTC markets. But if we mean institutions like hedge funds are in these OTC markets. Hedge funds per se aren't causing, or there is really no effect of hedge funds or no hedge funds as measured by 13F filings in the OTC markets. So to conclude, we look at asset pricing in the dark. We look at inefficient, illiquid stock markets. These are large. There are lots of these stocks. They're very thinly traded, and they're interesting precisely because they're very different from the listed stock universe. They're extremely poorly and thinly held and thinly traded. We see very few institutions in this market, and it's very hard to short. So those are all interesting features. The bottom line, though, is that these are markets where these return premiums, especially for illiquidity, are large. And if you're really smart and very clever about trading in these markets to lower transactions costs, then these are markets, because there's very little information there, these are markets where you can make a killing.
One of my clients does portfolios of closed-end funds with proprietary expected return model, just historical covariances, lots of constraints. It has an all-country world index benchmark, and we don't want to deviate in how much too much from the benchmark in this way and that way. We have a turnover constraint, but we also have liquidity constraints. So he has a weekly cycle of looking at closing prices and everything like that, doing a computation, and then Monday starting to trade. But clearly, if we are trying to accumulate a position or get out of a position, we don't want to accumulate. In fact, the typical constraint is we don't want to try to accumulate at any one time too many days worth of, in a week, you don't want to get a month's worth of trade, maybe 2 days worth of trade, and you don't want the total position to be too many days worth of trade, because when you get out, you're not going to get out. So you don't want to get more than 6 days worth of trade, your total position. Now, suppose that an institutional investor, or somebody with reasonable, fraction of $1 billion, $1 billion, or a fraction of $1 billion, or multiple $1 billion, wants to get, did a similar kind of methodology with yours, where they're, weekly cycle or monthly cycle, and you've got lots of things which never traded all month. You're going to have zero position in it. So one of the questions my friend, my client, Tony Tessitore, my client and friend, gets asked is, how much money can you manage? And he can do the Monte Carlo analysis and so on, where, of course, the percentage of his portfolio he can invest in any specific illiquid asset, the size of the position he can take as a percentage of his portfolio goes down as his portfolio goes up. So my question is, one of the things you might think about going back and asking yourself is, how large of a portfolio could get any excess return out of this kind of investment?
I will refer you to Table 7 of the paper, where we actually do similar exercises to that question. I think my short answer is that this is not scalable for an investor that has hundreds of billions of dollars. It's a very small market for that. Now, if you are patient enough, you can compute break-even horizons that will take out that transactions costs. That turns out to be 4 to 6 months for illiquidity, as we see here. So if you have a longer horizon than that, it would probably make sense if you're fairly small. You could do it. We have break-even horizons for the other premiums that are computed here too. I agree with that. So size, I actually don't have a good answer to that, and some of these are very illiquid. But if you have $100 billion, you can't do this. I agree with that.
You're working from 1977 to January of 07, so you've got 30 years of data. But in the last 2 years, you've had both Twitter and Seeking Alpha and a lot of things that might even be called misinformation come out and really hit upon these sectors. So, I mean, a lot of it is, you know, you get spikes, so on and so forth. You know where I'm going. You don't have any of that factored in because in January of 2007, it wasn't really thought about. How do you bring that up to 2013, 2014, given what you know today?
The information environment has certainly changed over time for this, and I think some of the events that we've seen over the last couple of years are very similar to the attention that this market got during the late 1990s. During the late 1990s, you had huge buzz about all these internet companies. Many of them were on these OTC markets, and that's kind of similar to perhaps the past couple of years. So these things, I think, actually go through cycles. If we take the 1990s, these premiums are certainly there. We have that graph. You can take that period out. What's, I think, different about the current period is that in the late 1990s, it was mostly US or Canadian stocks that were here. And now we see lots of stocks from overseas. You know, there's a very famous firm, Muddy Waters, that concentrates on really bad Chinese companies. There are lots of these companies on these OTC markets right now. We don't examine those. We actually deliberately only look at US listed, US domiciled registered stocks. But this universe for OTC stock is 2 to 3 times larger if you include all of these overseas stocks and all the ADRs that trade on that. From an investor point of view, though, I think the difficulty in trading in size is not so much buying. If you're very patient, you're very clever, you can do that. It's actually shorting. You know, getting the find in and finding that, you know, someone to borrow that stock is very difficult. And it's even more difficult for these overseas companies.
If I'm the buyer on every trade that you ever observed, I can buy at most 500 million per year, and presumably then I will eventually own the entire market. So if I would at most want to participate in 10% of the trade, let's say, then it would be 50 million. So it doesn't seem like a trading technology. It's not. I don't think with good trading technology I could take a large. It seems like I could at most be buying in the tens of millions per year, as far as I can tell.
I agree with that, but I think the way to look at these results is that you would never want to take positions in hundreds of stocks in this market. And in fact, physically, you wouldn't be able to. So you would want to use the best predictors that you can. There are some that have been identified here. I think illiquidity is extremely strong in this market. And you would hold small baskets with the best predictors of those stocks. And so rather than trade hundreds of stocks that we do in listed markets, you trade 10. This is, as I started the talk, these are markets where if you are small and nimble and you are skillful and you are able to trade very well, you can make money. But there are returns for doing that, and not everyone can be like that. Thank you very much.